Silver just did something the financial channels are not going to sit you down and explain, because the story behind it is inconvenient for the people who make their living off your patience running out. There is a warning buried in this metal right now, and it is not the kind that flashes red on a screen. It is quieter than that, and older than that. It has been building for longer than most of the people talking about silver on television have been alive. If you are holding silver right now, or you have been thinking about it, watching it swing around and wondering whether you missed the move or whether the whole thing was a mirage, I want you to stay with me. Because what is happening under this price is not really about this month or this quarter. It is about a pressure that has been coiling for the better part of half a century. And by the time we are done, you will understand exactly what that pressure is, why it matters more than any single day's headline, and what history says usually happens when it finally lets go. Here is the fact I want to hand you right up front, so you know this is not just talk. Silver spent roughly 45 years trapped beneath a single price ceiling. Think about that. 45 years. There is no other major market on Earth that has done that. Stocks make new highs every cycle. Gold reclaimed its old peak and blew past it. But silver has spent almost half a century below the high it set back in 1980, and it only kissed that ceiling one other time, decades later, and got thrown right back down. That is the longest consolidation, the longest base in any market that matters. And bases like that are not weakness. They are the launch pad. The bigger the base, the bigger the move that comes off it. That is the whole thesis of this video, and everything I show you from here reinforces it. Now let me tell you why that base matters, because this is the part the trading desks would rather you never think about. When a market spends a long time going nowhere, most people read that as a dead market. Boring. A place your money goes to sit and do nothing. And for 45 years, that is exactly how silver was treated. Retirees who bought it in 1980 and held it watched a whole working life go by. Their neighbors got rich in stocks, their brothers-in-law bragged about tech, and they sat there holding a metal that could not get out of its own way. It felt, for a very long time, like being the fool at the table. But here is what almost nobody understands about a base that long. Every year silver sat there, the world kept using it, not hoarding it the way we hoard gold, but burning it, consuming it. Silver goes into solar panels, into electronics, into the electrical contacts in your car and your appliances, in tiny amounts, a few grams here, a whisper there, dispersed so thin across so many devices that it is almost never economical to pull it back out and recycle it. Gold gets hoarded. Silver gets used up and thrown away. So while the price sat still, decade after decade, the above-ground pile that could actually come to market was being quietly drawn down. The market has run a supply deficit for years running now, demand outstripping mine supply, the gap filled by digging into stockpiles that do not refill themselves. A long, flat, boring price hid a slow structural tightening underneath. That is the coiled spring. That is the base doing its work. And I want you to notice who benefits from you seeing only the boredom and never the coiling. The big banks that run the paper silver market, the trading desks, the financial media that needs you tuned to the next shiny thing. A retiree who understands that a 45-year base is a loaded spring is a retiree who holds through the shakeouts and does not sell them cheap metal in a panic. A retiree who only sees a dead, boring market is a customer. They are not nervous about you owning silver. They are nervous about you understanding why you own it. Let me show you what a shakeout looks like, because you have probably lived through the most recent one, and it may have rattled you. Silver ran to an all-time high, and then it got hit, hard, a deep and fast correction that fell all the way back toward the very zone it had broken out from. It came back down and tested that launch pad, not once, but over and over, several times, like the market was checking whether the floor would hold. Now, if you were watching that on the financial channels, the story you got was fear. Silver is rolling over. The bull was a lie. Get out while you can. And here is the tell almost nobody pointed out to you. Through a lot of that drop, gold barely moved. Gold sat there, comparatively steady, while silver did all the violent swinging. And when silver falls while gold holds, all that has happened is silver got even cheaper relative to gold than it already was. The dip did not break the case. It deepened the discount. That is the pattern of every long base I have ever studied. It does not go straight up when it finally moves. It shakes you first. It comes back to the launch pad and it tries to buck you off, because the whole point, from the perspective of the people who want to own it cheaply, is to get the nervous, weak-handed holder to hand over his metal right before it goes. The shakeout is not the end of the move, it is the price of admission to the move. And this is exactly the moment I need to stop and talk to you directly. Because right here, when a market is shaking and the headlines are loud and your own account statement is making you second guess everything, is precisely when retirees make the mistake that costs them the most. So let me give you something solid to stand on. Here is a fact that is not in dispute and not going away. The central banks of the world, the most informed, most patient buyers on the planet, have been buying gold at a record pace, more than 1,000 tons a year for 3 straight years, roughly double what they were buying the decade before. Gold recently overtook the euro to become the second largest reserve asset central banks hold, behind only the US dollar. The biggest players are quietly moving into hard money with both hands. And there is a perfectly legal, quiet way an ordinary American retiree can do the very same thing with the savings they already have. You can move a portion of an existing 401k or IRA into physical gold and silver, real metal, held inside a retirement account, without triggering taxes and without early withdrawal penalties, using a properly structured, self-directed precious metals IRA. I put together a free retirement protection guide that walks through exactly how it works. If you're watching this on your TV, just scan the QR code on your screen. If you're on your phone or your computer, go to jeffreedguide.com. And let me be clear about who this is for, because there is a myth that this is some insider maneuver. It is not. If you have $100,000 or more in any retirement account, this is for you. The same tool the biggest institutions on earth are using, available to you. Get the guide, and if it fits your situation, there is a free one-on-one to walk you through it. Then come right back, because the history is where this gets real. Let me take you back, because I promised you what long bases do, and the record is unusually clear. Go back to the 1970s. When the dollar was cut loose from gold at the start of that decade, gold was priced around $35. By the end of the decade, it had gone over $800, roughly a 20-fold move in 10 years. But here's the part they never tell you, the part that would have shaken you out if you did not understand bases. Right in the middle of that historic run, gold did not go straight up. It fell by nearly half, cut almost in two mid-bull, while everyone who did not understand the bigger picture swore the run was over. And then, from that shakeout, it multiplied roughly 8 times into its final peak. The people who read the mid-cycle crash as the end missed the largest part of the entire move. Silver did the same thing, only more violently, because silver always moves more than gold, in both directions. It ran to that ceiling near $50, right at the top of that era. And then it spent the next 31 years, an entire generation, before it got anywhere near that number again. When it finally clawed back to that same ceiling, decades later, it hit it and got thrown right back down. 2 touches of one price, roughly 31 years apart, and beneath both of them, that base I keep coming back to, now about 45 years deep and counting. And here is the detail that should stop you cold. That old high, adjusted for what the dollar has done since, adjusted for real inflation, is not near where the price is now. In today's money, silver's 1980s high sits well up into the low 3 figures. Silver has never, not once in real terms, reclaimed the peak it set almost half a century ago. Every other asset you own has made new real highs many times over. Silver has not made one. The base is not just long, it is deeper than the nominal chart even shows you. Now, here is the part that actually changes the picture, the part almost nobody connects. Why did that base last so long? Part of it is real, physical, structural, the slow drawdown I described. But part of it is engineered, and this is where you meet the enemy again. The silver price is set, day to day, not in the world of physical metal, but in the world of paper claims, contracts traded on exchanges, many, many paper ounces layered on top of every real ounce that actually exists. And in that paper world, the rules can change on you. We watched it happen. Not so many years ago, silver was running hard, and the exchange stepped in and raised the cost to hold a position, over and over in a matter of days, and silver dropped around 30%, fast, even though nothing whatsoever had changed about the actual metal, the actual mines, the actual deficit. Nothing physical changed. The rules changed. And plenty of leveraged traders got flushed out of positions that were fundamentally right simply because the paper terms moved against them at the worst possible moment. You have seen this in other metals too. There was an episode in another metal market where the exchange looked at a squeeze developing, where the paper was losing to the physical, and it simply canceled trades that had already happened. Completed trades, erased, because the metal was winning and the paper could not pay. Sit with what that tells you. When physical reality and paper promises finally collide, the people who wrote the paper have shown they will change the rules to protect themselves, which means every long stretch of a suppressed, boring, going nowhere price should make you ask a different question. Not why is this metal so weak, but who benefits from it looking weak, and how long can that actually last when the physical is draining underneath? I told you at the start there was a warning here, and now I can make it plain. The warning is not in the daily price. The warning is in the shape of the whole thing. 45 years is not a slump. It is the largest, longest coil in any market on Earth, sitting under a metal the world cannot stop consuming, held down by a paper system that has already shown it will bend its own rules under pressure. That is not a description of a dead market. That is a description of a spring that has been compressed longer and harder than any other, and springs like that do not release gently. And let me connect it to something happening right now that fits the pattern perfectly. The world got a new Fed chair, and the market expected him to be soft, to cut rates, to be friendly to hard assets. Instead, his posture came across as tougher on inflation than anyone expected, and that surprise is a big part of why silver got hit, and why gold and silver went through their correction. Now, hear what that is. That is a policy surprise, a shift in the rules, in the tone, in the expectation that knocked the metal down while changing nothing about the deficit, nothing about the solar demand, nothing about the 45-year base. It is the exact same species of event as the margin heist, as the paper games. Something at the policy level shakes the price, the headlines call it the end, and the physical story underneath does not even flinch. Here is your mid-video gut check, plain and short. Does the end of a bull market look like the whole world piling in? Yes, it looks like mania, like everyone at the barbecue suddenly a silver expert, like a line around the block at the coin shop. Look around you. Is that what you see? Or do you see a metal most people still ignore, that the mainstream still calls boring, that just got called a failure on the very channels that never understood the base in the first place? That is not what a top feels like. That is what the quiet before a move feels like. Let me be honest with you the way the financial channels will not be, because your trust matters more to me than a dramatic story. Nothing I have said is a promise of a price or a date. Silver is volatile, more volatile than almost anything else you can own, and it can shake you violently, even when the long story is intact, maybe especially then. This is a case built on history and structure, not a guarantee, and it is not personal financial advice for your specific situation. History rhymes. It does not repeat on a schedule you can set your watch to. Anyone who tells you they know the week silver breaks out is selling you something. So what do you actually do with that? A few principles, not a prescription. Own the real thing, physical metal, not a paper promise that can be changed on you at the worst moment, because the whole lesson of the base is that paper bends and metal does not. Size your position so that a shakeout, and there will be shakeouts, can never force you to sell, because being forced to sell at the bottom is the single way this story hurts you. And do not hand your metal to the desk that is trying to scare it out of your hands. The shakeout is designed to separate you from it right before the move. Understanding that is most of the battle. Which brings me to the thing I most want you to walk away feeling, because it is the real edge you have. Right now, you are early. The smart money, the central banks, the most patient institutions on Earth, they already see this. They are already positioned, buying hard money at a record pace while the public looks away. The pension funds, the financial media, the average advisor, they have not caught on to the silver story yet. And that gap between what the informed few already know and what the crowd has not yet noticed, that gap is the entire opportunity. Because by the time it is obvious, by the time silver leads every news segment and every advisor on television is recommending it and your neighbor is bragging again, the easy part of the move will already be behind us. That is how these things always go. Nobody sends you an invitation to be early. Nobody is going to call you and tell you the base just broke. You either understood it before the crowd, or you bought it from them after, at their price. So here is where I leave you, and it circles right back to that warning I opened with. The biggest, longest base in any market on Earth, 45 years beneath a single ceiling, coiled under a metal the world keeps burning and cannot unburn, held down by a paper system that has already shown its hand. The bigger the base, the bigger the move. That is the warning silver just sent, and it is the same warning it has been building quietly for almost half a century, waiting for the people patient enough to hear it. If you have watched this all the way to the end, you are exactly the kind of person this next part is for. I hold a free, one-on-one educational web conference for viewers with $100,000 or more in retirement savings, where we walk through your specific situation and how physical gold and silver could fit inside the accounts you already have. Mention that you watched this all the way through. If you are watching on your TV, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. And do it now, while nothing feels urgent, because the moment to make a calm, clear-eyed decision is exactly the moment when the crowd is still looking the other way. By the time it feels urgent to everyone else, the easy part will already be gone. You were early enough to be here. Be early enough to act on it.